we're having on the question of innovation in the financial system and what's the appropriate response. And I want to be very clear that I think overwhelmingly, probably unanimously, members of this committee welcome innovation in the financial system. And I believe in the essential rationality of the market system. I don't think you get innovation unless those innovations do some good and meet a need. I don't think that this is purely random. On the other hand, there was a tendency, and I was pleased to see Secretary Paulson say essentially that a week or so ago, for innovation to outrun regulation. That's very sensible. You don't regulate in the abstract and in anticipation generally. What we have been able to do, I believe, in our financial system over time is to create regulations that allow the financial system to do its work with some protections, and we should not lose sight of the fact that an important part of the regulation, we talk about investor and consumer protection, which is important. We obviously have the concern about systemic risk, which today is the most important, and I have been saying that seems to me less important than investor protection, but here we have an issue. We see this in some aspects of subprime where investor protection becomes at the very least market enhancing, and in some cases it may be a necessity for market. That is, in the current situation, we are confronted with a substantial lack of investor confidence, and simply talking our way out of it doesn't work. Sensible regulation that provides some degree of quality assurance is very important if you want to get a market going again. My view is that if we want to get back into a secondary market for mortgages, and I believe the secondary market for mortgages has had enormous benefit as well as causing us problems, that can only be done if in the near term, if the investors have some confidence in the quality of what they're being asked to buy. And that's one of the things we're working on. I was pleased to see that Chairman Bernanke acknowledged that. We have been focusing on the subprime issue, and it seems to me that's a clear case of innovation leaving regulation behind. And if you look at the regulated set of institutions that make mortgage loans, the banks and the credit unions subjected to state bank authorities, the FDIC, the OCC, and others, the problems weren't there. The problems arose in the unregulated sector. We had a pretty good case study of this. And our job, in part legislatively, and it's a job which the ranking member and the gentleman from North Carolina who's here, Mr. Miller, gentleman Mr. Watt, and I started working on 2.5 years ago. And we were rudely interrupted, but we will restart that up to do, essentially, we know that there are regulations in the area of mortgages that have worked reasonably well. And to some extent, our job is to write those down and apply them to everybody who regulates mortgages. We also, as I said, want to put some confidence into the investors in the secondary market that they have some quality assurance, and that, I think, goes to the duty of the servicers, the active element in the packaging and selling. The question that is harder to answer is, what do we do about the broader market? We should be very clear. Virtually everybody was surprised by the extent to which the problems in the subprime market spilled over into the broader market. There are people who tell me that they saw it coming. I have asked them for any copy of the correspondence in which they notified anybody else. So far, nothing. The Fed acknowledges it was surprised. The Treasury was surprised. The Financial Services Authority in England was surprised. The EU. No one saw the extent to which this was going to spill over, at least no one in the regulatory area. That raises the first question: do they need to have more information? Certainly that ought to be at least a minimum amount that we do. I also want to be clear, we are not here focused on the particular entity that does the investing. It's not hedge funds, it's not private equity, it's not investment banks. It's the type of investment, particularly the great increase in leverage. A combination of technology and other factors have allowed people to do virtually a new form of investing. People will tell me maybe it's always been there, but as Mark said, in this case accurately, changes in quantity become changes in quality. And that's what we have to look at. Are there in our financial markets today, is there a degree of leverage that people have lost sight of? We can say that individual entities know what they have. But do they know what everybody else has sufficient to make a judgment? Do they know that if they need to get out of a certain instrument, they won't be in a race with a lot of other people trying to do the same thing, devaluing what they have? And I am pleased to say that the regulators share this sense that we really need to take a hard look at this and think what it is we have to do. I also will note one thing with a little satisfaction. Little less than a year ago, when I became the chairman of this committee, the dominant discussion in the financial press was the need for us to deregulate very rapidly, lest everybody with more than $100 go to England. There was this fear that we were going to be depopulated in our financial markets, and we had the McKinsey report from Mayor Bloomberg and Senator Schumer. We had the report that Secretary Paulson got out of Harvard Law School. And clearly we have to look to our competitive situation. And we've done some things that we think help with that. And I've been a supporter of the SEC, for instance. I think this committee in general has, of trying to work with the European authorities to get joint accounting, to do other things that will ease transnational operations. But I think the tone has shifted. We are still talking about the international aspect, but we've shifted from a kind of argument that we had better deregulate more so that we catch down with England, to the notion that the regulators need to work together to create some rules. There is an understanding, and in fact, I don't know if there are as many enthusiasts. For instance, in Europe, some of them were hit pretty hard by the consequences of our unregulated subprime market. So obviously, regulation should be diminished. This committee is working, for instance, with the American bankers and the Financial Services Roundtable to cut down the amount of paper that has to be sent to the Treasury, which we think is unnecessary. There are other regulations where we have moved to cut back. But on this whole question of whether or not the fundamental regulatory structure is today adequate to keep the regulators informed of what's going on in these new developments in the financial market, that's very much an open question, and that's what we are focusing on here, and I appreciate the witnesses joining us. The gentleman from Alabama is recognized for his opening